Welcome back to the Traders Network. I'm Michael Yorba, your host. Thanks for joining us. We are also streaming to you live on yorbamedia.com. All right, Nick Santiago, President and CEO InTheMoneyStocks.com. Nick, welcome back to the show.
Great to be back, Michael. Thank you for having me.
My pleasure, and thank you for keeping all the people that listen to our show, especially when you're on, out of trouble, because I think you were saying, I'm not ready to buy this market yet.
No, we talked about that, and anybody that's been part of our trading room knows that we've been looking for this gap fill to be hit on the S&P 500 from basically the May 2nd gap up. So, not a real shocker here. QE3 looks like it's over, and we'll see where we go from there.
Okay. All right. You want to start off with that famous market, or the JP Morgan, that stock that just gave us the tell of what was going on. What's happening with JP Morgan today?
JPM did kind of give us a little bit of a tell, because you could see that had that sell-off there from May 30th, and then really just sideways consolidation. The stock wasn't able to recapture its high from May, and it's not like the stock is in a death sentence or anything, but it's just a good stock to use as an indication. And when we saw the markets as vulnerable as they were, and then you have JPM on top of it not making new highs, it's kind of a little bit telling that we could have some news out there to bring the markets lower. And sure enough, it happened to be the QE catalyst. But JPM right now, I think traders want to watch the level at $50. There's your bounce play at $50, but that may not last all that long. So if you're an aggressive trader, you could try to own this thing around the $50 level, probably for a week or so, and then if it gives you a bearish pattern, JPM can go a lot lower.
Okay, all right, got that. All right, now at the same time, which doesn't always happen, you get bond market, 10-year notes, and the stock market going down at the same time, an anomaly sometimes. You know what I mean?
Yeah. I mean, this is right now, funny thing was when money came out of the bond market, everybody assumed it goes into the stock market. Remember, Michael, I was on your show several months ago saying, hey, that's not going to be the case. When money comes out of the bond market, it's going to hurt the stock market because yields are going to go up. I mean, how is the U.S. government going to even pay its debt service right now? So I think that higher yields hurt utility stocks, higher yields hurt mortgage REITs, higher yields hurt the home builders, also the consumer staples. So higher yields are definitely a negative. And right now I have a target for your listeners. If they want to know where the yield is going on the 10-year, it's going to go to 2.9%.
Okay, all right. Tell me about how you came up with that number. Just to throw it out and have a clear, concise target like that is remarkable for anybody to have the guts to do that one. Very commendable.
Well, I actually gave that level to you last week on your program, and I said, we probably are due for a little bit of a pullback first, but get ready. These yields are going to break out to the upside, and today they're sitting right around 2.42% on the 10-year. But if you go back and you look at a weekly chart, what you're going to notice is if you go back to June 2011, even into the late July 2011, there was a period there where yields just stalled just under 3%. And I think that, markets love to go back to where they came from. And the way I've calculated this with the momentum off of the downside is that ultimately 2.9% is going to be our target on the 10-year Treasury yield.
Okay, all right, got that point. Now, you brought up an ETF that we can use, $TNX, the 10-year Treasury. I'm looking at it. I've got a clear doji the way it sits right now. Are you thinking a little bit pullback and then buy this again, or what?
Sure. This is a great opportunity for everybody to watch for pattern now. And if it gives you any kind of a consolidation pattern, and this is one of the things that I teach all of our members here at In the Money Stocks is, if this gives us a bullish consolidation pattern, the 10-year Treasury yield can go higher. And how you play that is by buying the TBT. And you can also play it by buying the PST. And those are two inverse charts to bonds, so they'll trade right along with the yield chart. And you could use the yield chart to play those equities.
Okay. All right. What about the TLT? It looks like we might have some kind of a short-term reversal signal here, a gap down and then rallied back up. Do you think that's the case, or maybe more follow-through?
Yeah, right now the TLT went down to around 109.37, so I think we're probably due for a short-term bounce. Again, it's had such a big move down. If you take a look at the weekly chart, this has been down really since late April. So, we're overdue for some kind of a bounce in the TLT. So I do think that we're probably due for a short-term bounce. But ultimately, I have the TLT going down possibly as low as $95.
Okay, that is a pretty good. That's still more room in the trade. All right, short the bounce, and they have to get in your trading rooms to actually really.
Yep. Come on over to the trading room, and we'll show you exactly how we're going to do it. And again, just a little while ago in my chat room, I said to our members, I said, hey, there's two big levels coming up on the TLT. One is 109.40, and the other one is 107.11. And the 107.11 is the weekly chart, 200-day moving average. And I said after that is 105. I said markets rarely go straight down in a straight line. There's going to be bounces here. So, you have an opportunity now with the bearish pattern to get in and short that TLT, and you could do that via buying the TBT.
TBT, got it. All right, now the oil market, USO, it's right here at the 200 period moving average on a daily basis. Just touched it exactly at the low. What do you say for this?
Yeah, I think the oil market's headed a little bit lower. Now this is another one. I think that people could look for the oil market to get some kind of a bounce in the near term. But I had just put out a short alert on the USO in my trading room. We didn't get triggered. It didn't get to our level. Our level was between 35.90 and 36.28 on the USO, and we were looking to short it up there. But it already started to fall a little bit ahead. So what you do now is you just look for a bearish pattern. The USO should head down to around the 32.40 level, and then ultimately I think it goes down to around $30.
Wow. All right, give it in crude oil terms because we got about almost a 356 right now lower, $3.56 a barrel in 1 day is a pretty good move there.
Yeah, it's a very, very solid move lower in crude. Right now, the way I'm looking at it, crude trading finishing at around 95 and change. I'm looking at crude to get down to around 91.
Okay, so about 91. Are you thinking that would be a good place? I mean, provided the pattern sets up to get long for another major rally.
No, I think you could get long for a bounce, and then look to short it after pattern down to around 87.
Okay. All right. Good. Now let's go over to natural gas. That's been another big mover for us. We've covered all the normal stuff that we bring to the table. We've got some elbow room here with a few more minutes on the segment.
Sure. Well, natural gas, I guess right now is around 388. So if we look at the charts on natural gas, there's still a ton of support around the 360 level. I would be a buyer around there.
Okay. All right. 360, buy it on the dip. Got it.
Yeah, I mean, natural gas right now is still a very strong chart. It remains above its 200-day moving average. Had a beautiful breakout in February and April. Right now, it looks just like a natural pullback on natural gas right now.
Okay, all right. Now, once again, let me disclaim that. Don't just try this with your eyes closed, ladies and gentlemen. Get into the trading room, watch the triggers get pulled, and have some guidance on this stuff. Don't do it alone. But speaking of that, tell me, we got about 3 minutes left in the segment. Tell me about what happened in the trading room today.
Well, we've had a lot of scalps. As you know, we had that big gap down today, and the Dow is down 254 points at the moment. So, during the lunch hour, it was kind of a little quiet. But as I told my members today, I said you could look for a late-day sell-off in this market beginning around 2 o'clock, 2:30. And, most of them are just trading the market lower at the moment, the S&P 500, that is.
Okay, going into the close, what are you thinking?
We're going to finish probably at the dead lows today, somewhere, around the 159 and a quarter level, on the spiders, that is. So it's a pretty good sell-off today, and it just goes to show you that, these markets are meant for trading. They're not meant to be falling in love with like many people have done with the Federal Reserve printing money every day. Hopefully those times are over and we get back to some real markets, and traders could see that it takes skill to understand the charts, and that's what we try to do each and every day.
Okay, all right. Here's the question I've got for you. Do you think that this is a normal pullback that could be bought for a later gain going into later in the year, or have we broken the camel's back?
Well, I think we broke the camel's back for now. Later in the year, obviously, we'll be buyers at some point. 2013 is ultimately a bullish year. So, but we haven't had a single 10% correction, Michael, since last June. So this market is well overdue for that. At this point, we're just going to watch the technical levels. We'll watch the patterns, and we'll trade both sides of the tape. As you know, I've been probably aggressively shorting the market for the last 2 months. So now is a time where if it gets down to a certain level, I'll be a buyer of the market, and then we'll look to sell it again and buy it again and just rinse and repeat using the same methods.
I got to say that one yesterday. Okay, give me quickly a kind of a rough target for buying the market if it gets there.
Well, there are going to be a few big levels. Right now, I'm thinking in the short term, if we got down to around 153, that would be a nice bounce area for the S&P spiders. So that would be a level that I would look at right now. If you're looking at the S&P 500 cash index, somewhere around that 1,500 level looks pretty decent, at least in the near term. But again, I think it should just be for trades, maybe even 1,530. That's a pretty decent area.
Wow, what a great place to readjust the portfolio. Okay, but one more time before we go, how do they get into the room, and when can they start trading with you?
Yeah, you just come on over to InTheMoneyStocks.com. We have our live trading room, which I feel if you're a professional trader or you do this every day, you can't live without. You'll get all of our levels, whether it's stocks, commodities, bonds. It doesn't really make a difference. If you can trade it, if it's a chart, we can trade it, Forex as well. So come on over. You get to look over our desktop and see everything on your own computer screen. And then if you work a 9-to-5 job and you trade the markets, come over to our research center. You get all of our cycle work, all of our nightly swing trade setups. Great. I mean, it's an invaluable service.
It definitely is. You more than make your money back on every trade. I mean, I shouldn't say that. That's a little too braggadocious, but I mean, you have exuded such confidence in the people that have come to the show and gotten into the room with you that they turned out to actually it spills over into the rest of their life, not just their business life and trading. You've helped a lot of people, I know, and I want to say thank you from the bottom of my heart.
Thank you, Michael. Appreciate that. Appreciate that a lot.
My pleasure. Nick Santiago, President, CEO in the Money Stocks. On the other side of this break.